types of mortgages available?
Okay, that's a good question, because each mortgage fits a different situation. And
Right.
what I'm going to do as a loan officer with experience is I'm going to evaluate your situation and put you in the best product that fits you at this time. Or I will tell you what to do to get to a better product if that's what you're looking for. But I don't just try to steer you towards a product. I try to assess what you're at right now and tell you the best product, and usually give you one or two options depending on what happens. So you've got conventional loans, and that's what most people want typically. That's usually the better rates typically. And also what happens with a conventional loan, it's basically with a conventional loan, you can get in and you don't have private mortgage insurance for a length of time, even if you have any of it. But usually that's definitely where the scores are important. If you have a 740 plus score, and they will go up to 850, though I've never seen one, but if you have a 740, 790, 810, it's going to be all the same to the lender because it's excellent credit. And what we do to determine that, and I wanted to mention that to you, when we pull a credit report, we pull what's called a tri-merge. We get all bureaus, Equifax, Experian, and TransUnion. And what we use for pricing and loan to value determination, depending on the product, is going to be the middle numerical score. We do not average them, we use the middle numerical score. So if you have an 810, a 790, and even a 500, which won't happen, we're going to use the 790 because it's the middle numerical score.
Okay.
So that's what we go by. With conventional, again, we can go down to a 620 score and you can get an 80% loan to value. So if you have 20% down, and at this particular day in the market, closing costs, which can be negotiated, just keep that in the back of your mind with the seller, because generally when you buy a house, the buyer is responsible for the closing costs, the seller pays the realtors. However, for negotiation tools, you can remember that what the seller wants to net is what is important. So if they can net what they want to net, they can actually pay some closing costs towards you within guidelines, so it keeps money in your pocket. But what happens again with the score and with a conventional loan, you're typically going to be putting in anywhere from, say, 20% down up to 5% down. And what happens with that particular product, you have what's called private mortgage insurance. And when you go over the 80% loan to value, the LTV, up higher, that rate for the mortgage insurance gets higher up until 95% loan to value. So it's more per month because there's more risk for the lender, because what they're protecting is their money that they've given to you over the 80%. I have a lot of well-established buyers that can pay cash for houses. They typically come in and say, hey, listen, I'll have my money go elsewhere. I'm going to do an 80% loan to value. But I've had many of them do an 85% loan to value because they get to keep 5% of their money. And that can be a lot of money sometimes. And their mortgage insurance factor is very low. It could be $20, $30, $40 a month at most for that. And it comes off real soon because you're getting close to that 80% loan to value, where private mortgage insurance comes off automatically. So that's a good thing. Again, it's showing you that I will try to design the product to fit your needs on that sort of thing. On top of that, conventional rates usually a simpler loan, more established people, because people usually have some down payment. The government loans, on the other side, there are actually three of them typically used. One is going to be an FHA, which is Federal Housing Authority. One is going to be USDA, which is the U.S. Department of Agriculture. Doesn't help you buy farms, but it is for rural properties typically that follow in. And then the other is going to be VA loans. And I will ask you during our interview to see which loan is going to fit. One of the questions that we actually have to ask in the application is, have you ever been a service member? Because a VA loan has got all sorts of benefits that other loans don't have, from being 100% loan to value to having no mortgage insurance at all. So they're really, really nice on that sort of thing. Now, the second loan that's more prevalent is going to be the FHA loan. Okay, and what that typically does is up to 96.5% loan to value. So on a $100,000 purchase, that's $96,500 that's going towards the purchase of your house. You come up with 3.5% plus closing costs. Now, that's easier to get. You can do the 96.5% down to a 580 score, which is a really low score typically for the mortgage business. your debt to income ratio will increase. And what the debt to income ratio is, it counts all your debts to see how much house you can afford. And they have what's called a front end and a back end. And this is true for conventional as well. The front end is basically going to be just the house debt. And then the back end, what that means is the house debt plus all your other debt. And there's always a difference there, but they have guidelines for each product. And so what will happen is when you go FHA, you'll have a higher debt to income ratio above a 620 score, and then up to whatever score, because sometimes people have to do it with a high score because they want to buy more house. They can go up over 50% DTI, sometimes 55, sometimes a little higher depending on the system. Whereas a conventional loan will typically max you out at about 45%, sometimes over 50, depending on what the system reads. Because we have what's called a desktop underwriting system that actually we key in that information. If we key it in correct, it'll tell us right then and there if we've got an approval or not, based on the numbers we put in. So if we put in good numbers and we get a good pre-approval, you'll know what to do. If I put in bad numbers, which is really, really rare, okay, I double check myself all the time, I could give you a pre-approval that wouldn't work. And I just don't have that. I have a very high pull-through ratio on what I give pre-approvals on because I do the work up front. And the accounting degree does help. But the FHA loan, I typically will tell people, that is for people with fractured credit and lower down payments. And it works better. Because with an FHA loan, you can actually have the seller, you can actually have the seller pay more of your closing costs at a higher LTV than with a conventional loan. But if it worked out that the FHA was the better loan, but you didn't have the very minimum, you had a little bit better, then you could get a better rate than if you just had the 580. If say you had a 620, but you didn't want to do conventional, would you get a better rate FHA? Typically FHA, and I would always have to check this at the time, and it will give us in the system what the rate is. Typically the FHA is not credit score sensitive. They either do it for you or they don't.
Okay.
Which is really nice. So sometimes people that have 20% down may go FHA, but then the issue is, and you've got to say, hey, is that private mortgage insurance that's in FHA, not private, but the mortgage insurance that's with FHA worth the difference in cost? So that's why it's got to be evaluated. And once you're keyed in, once we key in the information, the parameters of your loan, like your income, your assets, and so forth, it's fairly easy to shift between products to see which one fits you better, which is going to be important to you. Mm-hmm. A lot of times I'll be able to tell up front just by doing loans, but the numbers will tell us what's there. I've actually had people that could go conventional, go FHA because it was better for them, and vice versa. I've had people that could go VA, Veterans Administration, go conventional because the loan was better for them. And that's due to a funding fee that VA charges on most loans, unless you have a 100% disability, which then the VA forgives that. So every loan has got its intrinsic
pluses and minuses.
Right. So the ability is to deal with somebody that does all the loans that are out there and that knows the products. And if they don't know the answer, if I don't know an answer on a product, I will find out what it is, because that's important to you. Because guidelines do change every day. You know, most of them don't, but there are those nuances that change on that. Now, a USDA loan is usually a 100% loan for out in rural areas. I can actually determine if the house fits in it or not by going to a website and keying in the address. But they do have limited incomes, so you can't make too much to do a USDA loan. If you do, they'll disqualify you. And you can't have too much in assets either. Because if you have the ability to put 20% down on a property when you buy it, they will not let you do a USDA loan. Because they want to save it for the people that don't have the ability to do such on that sort of thing. There's another aspect that we do too, and this is just a different program, and it's great for Virginia. It's called Virginia Housing. It used to be called VHDA, but they changed their name to Virginia Housing, so I just call it VH now. And what that does for people that have lower incomes and so forth, and the incomes are still fairly high. They're in the 80,000, basically in the Roanoke area for, 2 people to 4 people, and sometimes they go on up. But what that does, it lets them get 100% financing in a number of ways. One is by a Virginia Housing Plus loan, where on FHA, they will do a 96.5% first, which will be FHA, and then Virginia Housing has a second, it's actually a conventional second, that takes care of the 3.5%. So you have 100% financing. And generally, if people need that, and if they're in the city, we go that particular route. The income qualifications are a little less, debt to income ratio is a little less than FHA, but if I can fit you in that parameter, we can do that. They also, Virginia Housing also offers grants. And what that is grants for either down payment or some other systems like that. And actually, conventional has a grant program as well, depending on how much income you make. But if you make too much, it kicks you out of those grant programs, that sort of thing. So there are a lot of products that are out there.